You won't believe what just happened. Trading was halted across multiple platforms yesterday, and when it resumed, the rules had completely changed. Billions of dollars were locked up. Retail traders couldn't access their positions, and the biggest players, they got special treatment. This isn't conspiracy theory stuff. This is documented, this is real, and this is happening right now while most people are completely unaware of how the game is being rigged against them. Stay with me, because what I am about to show you will change how you see the markets forever. Let me take you back to what actually went down. Yesterday morning started like any other trading day. Markets were moving, volatility was picking up, and retail traders were actively managing their positions. Then, suddenly, without warning, trading platforms started issuing halt notifications. At first, people thought it was a technical glitch. Maybe servers were overloaded. Maybe it was a routine maintenance issue. But this was different. This was coordinated. This was deliberate. And this was about to expose the entire structure of how modern markets really work. The halts started hitting specific stocks that had massive retail interest. We're talking about names that had been trending on social media, stocks where everyday traders had finally figured out a winning strategy, positions where the little guy was actually making money for once. And that's when everything stopped. Trading platforms froze these positions, prevented new orders, and in some cases, forcibly liquidated people's holdings at the worst possible prices. Meanwhile, institutional traders, the big hedge funds and market makers, they kept operating. They had access. They could move. They could adjust. The retail trader? Locked out and watching their account balance drop in real time with zero ability to respond. Now here's where it gets really disturbing. When trading finally resumed, the rules had changed. Not weeks later, not after public comment periods or regulatory review. Immediately, same day. New margin requirements appeared out of nowhere. Stocks that previously required standard margins suddenly needed 3 or 4 times more collateral. Options, strategies that were perfectly legal in the morning, became restricted by afternoon. Position limits were slashed. And all of this happened while retail traders were still locked out, unable to adjust their portfolios to comply with rules that didn't exist when they entered their trades. Think about what this means for a second. Imagine playing a game where you're following all the rules, you're doing everything right, you're finally winning, and then the referee stops the game, changes the rules mid-match, and when play resumes, you're suddenly in violation of rules that were just invented. That's not a free market. That's not fair competition. That's a rigged system designed to protect certain participants at the expense of others. And the craziest part? This is completely legal under current regulations. The exchanges and brokers have terms of service that essentially let them do whatever they want whenever they want. And retail traders agreed to it all when they clicked that sign-up button without reading 300 pages of legal documents. Let's talk about who really benefited from these halts and rule changes. When retail traders got locked out, market makers and institutional players had time to reposition. They could see the order flow, they could see where retail was positioned, and they had the access and the technology to take the other side of those trades at favorable prices. The moment trading resumed with new margin requirements, guess who was ready? The same institutions that helped write those requirements. They had the capital, they had the compliance teams, they had advance notice through their special relationships with regulators and exchanges. Retail traders found out about the new rules the same way they find out about everything else, by having their orders rejected and their positions force liquidated. The financial media spun this as necessary measures to protect market stability. They brought on experts who explained how increased volatility required enhanced risk management protocols. They talked about systemic risks and the need for circuit breakers. But notice what they didn't talk about. They didn't mention how these same stability concerns never seem to apply when institutional traders need bailouts. They didn't discuss how high-frequency trading firms can cancel millions of orders per second, creating artificial volatility. But that's somehow fine. They definitely didn't acknowledge that every time retail traders figure out a strategy that works, the rules mysteriously change to shut it down. This pattern isn't new. We saw it during the meme stock surge when brokers literally removed the buy button. We saw it when retail options traders started consistently profiting, and suddenly options approval criteria became dramatically stricter. We saw it when day traders were winning, and the pattern day trader rule got enforced more aggressively. Every single time the average person finds a way to compete in these markets, the system adapts to block them out. And they do it under the banner of protection, claiming they're saving unsophisticated investors from themselves, when the reality is they're protecting the profit margins of the firms that fund political campaigns and regulatory agencies. Here's what makes this situation even more insidious. The rule changes aren't applied equally. If you're trading through a premium institutional broker with millions in assets, you often get different treatment than someone trading through a retail app with a few $1,000s. The margin requirements might be different. The access to certain products might be different. Even the speed of execution and the quality of prices can be different. The market has tiers, and retail traders are at the bottom tier, subject to the most restrictions, the highest costs, and the least transparency. So what can you actually do about this? First, understand that you're not playing on a level field and adjust your strategy accordingly. Don't over-leverage, because you now know the rules can change instantly and you might need more capital than expected. Don't assume you'll be able to exit positions when you want, because trading halts can happen without warning. Diversify across platforms if possible, because if one broker restricts access, you want alternatives. And most importantly, educate yourself on the actual structure of these markets. Learn about payment for order flow. Learn about market maker privileges. Learn about how exchanges operate and who they really serve. Document everything. When these halts happen, screenshot your positions, save the notifications, record what access you had and didn't have. Regulators claim they want to hear from retail investors, so make your voice heard. File complaints with FINRA, with the SEC, with your broker's compliance department. Most won't lead anywhere individually, but patterns of complaints do create pressure for change. Support organizations and advocates pushing for market structure reform. This isn't going to fix itself, and it certainly won't change because the big players suddenly develop a conscience. The truth is, the markets were never designed for the average person to win. They were designed by institutions, for institutions, with retail participation tolerated as long as it stays small and doesn't threaten the established order. The moment retail traders collectively figured out strategies that worked, that threatened institutional profits, the system responded exactly as it was designed to respond. It protected the insiders and locked out everyone else. And they did it so blatantly with such obvious coordination that it should wake everyone up to how this game really works. This isn't about being anti-market or anti-investing. It's about demanding fair markets where the rules don't change based on who's winning. It's about transparency instead of backroom deals between brokers and market makers. It's about equal access to information and execution quality. It's about holding regulators accountable when they consistently side with the firms they are supposed to regulate against the public they're supposed to protect. The question is whether enough people care to demand change, or whether we'll just accept that this is how it works and keep playing a game we're not allowed to win. The choice, ultimately, is yours. Please double-check responses.